Good morning, ladies and gentlemen. I hope you can hear me. My name is Francis Child. I'm the Executive Chair and owner of the Association Specialists, and I'm delighted to be co-hosting today's seminar on Investment Strategy 101 for Associations with Ryan Cormican, the Director from Evans and Partners. So, before we get going, I would just like to carry out the acknowledgement of country. The Association Specialists and Evans and Partners acknowledge the traditional custodians of the land and waterways upon which we work and depend. We offer our respect to the Gadigal people of the Eora Nation and the many traditional custodians throughout New South Wales. With strength and resilience, First Peoples cultures continue to endure, grow and thrive today. We acknowledge each community's continuing culture and pay respect to their elders past and present. We extend this respect to all First Peoples, including our clients, partners and broader community. We embrace the spirit of reconciliation and are committed to social, political, economic and cultural equity for First Peoples. We continue to work towards equality of outcomes and financial empowerment, noting the importance of the financial services sector, First Peoples' right to exercise self-determination. So welcome. I just want to have quick housekeeping. This session will be recorded and will be available to participants just at the end of the presentation. If you have any comments or questions, please put them in the chat room as we go, and we'll cover those at the end of the session. So I just wanted to briefly start with the why and why we think this is important. For all associations, I think it's important to remember that under Section 1811A of the Corporations Act, and sorry to be tedious, but there is a clause that a director or other officer must exercise their powers and discharge their duties in good faith and in the best interests of the corporation. So it's important to remember that you can't just sit there with assets sitting on your balance sheet doing nothing. And typically, if you just have your cash and things and basic term deposits, you're probably not even earning and covering your inflationary position. So today we're really trying to talk about your options and opportunities for those funds. The important things are to remember that you need to assess your risk and make sure that that's properly documented. Make sure that your board is fully across all the decisions that you make, and that they're properly monitored and reported on a regular basis. And finally, it's really, really important to use qualified advisors. Having said that, you need to be careful on who those may be. You'll remember Bernie Madoff in New York, I suspect. Was probably not the best example. I'm now going to hand you over to Ryan, who is properly licensed, qualified. So Ryan is a director and senior advisor at Evans and Partners, where he works as an advisor to Australian high net worth families and not-for-profit groups, including charities, industry bodies and associations. He consults through other financial advisory groups on investment strategy, asset allocation and investment selection. Ryan specialises in risk management and portfolio management, including research and security selection. He's passionate about educating his clients to help them navigate the complexity of the financial markets. Ryan, I'm going to hand over to you now. He holds a Bachelor of Economics from Macquarie University and a Master of Finance from Capital College. Over to you, Ryan.
Thank you, Francis. And it's great to be here with you all. I'm hoping that this is a fairly interactive session and not just me talking. So Francis, feel free to come through and interrupt with any questions that might be relevant that are coming up along the way. As we know with these sessions, it's usually a few takeaways, a few key points that come out that hopefully everyone in the audience will get and take away and be able to incorporate in their own organisation. I think what we're trying to do is just share what we consider to be best practice across the range of different not-for-profit organisations that we work with in terms of being proactive with the corpus. So just to start off with, for those that aren't familiar with Evans and Partners, we're an Australian-owned investment advisor. We advise Australian families and Australian not-for-profits. And as this slide highlights here, what really sets us apart in our market is that we have a dedicated service offering to not-for-profits. We advise well over 100 not-for-profit clients, and out of the approximately now $30 billion of funds under advice that we have fiduciary responsibility over and advise on, 2.7, more than 2.7 billion is in our not-for-profit business. We've got a proven investment process, which is very importantly underpinned by a strong governance framework. Now, governance, by governance, I'm talking about a central investment committee, which has independent oversight. And that's important to all clients, but I think it's particularly important to boards, and it tends to be a big part of the discussion early on when I'm talking to prospective not-for-profit clients. We also provide access to our clients to specific tailored not-for-profit resources, including education events, networking events for not-for-profit directors, and we also have a partnership with a strategic grants service. So we do consider ourselves a partner to our not-for-profit clients. We're not just there to advise, but we're there to find ways to contribute to and push the mission of each individual client. Importantly, the information I'm presenting today is backed by a team of 47 investment professionals, analysts, and chief investment officers in the company at Evans and Partners. So that's across macro, fixed income, equities, and another part that really sets us apart is a market-leading sustainable investment team. We have a headcount of 3 people in that team. So an important disclaimer here. Now we are discussing the information today in a general advice context. It shouldn't be interpreted as personal advice. Hopefully it is relevant. But the important point is that if you would like to drill down into further detail, we are obviously authorised to do that and have an Australian Financial Services licence. So when we're talking specifically one-on-one with clients, we can talk about their own individual circumstances and risk and return objectives. Just to frame up the discussion today, we're going to provide a bit of background to ensure that everyone sort of understands the reason that a board and a not-for-profit or association should be putting their money to work, and what it means if you don't. Number 2, we're going to just talk through the governance framework and the guardrails that we put in place with all of the not-for-profit clients that we work with, just to protect directors and ensure that future directors and any investment advisors understand their roles and responsibilities. I'll then talk about managing risk through asset allocation, and then finally I'll end up with a few slides talking through some of the important asset classes that are worth considering. So the slide that I've got on the screen here is the starting point, and quite often we see boards are simply structured with the brown and green boxes here, where income's received from membership fees, conference profits, and that contributes towards, was held in a savings account, and it contributes towards the expenses and wages, as well as ongoing capital requirements like projects and grants, etc., that an organisation might have. To take Francis's point made earlier, boards need to really be asking themselves, are we getting the best out of the corpus for the funds that we have that aren't actually committed to some of those capital projects, particularly in the near term? And the conclusion on this question is difficult. Is difficult to reach for boards. So it's about involving Francis and others and perhaps a professional investment advisor in the discussion, to understand really what is available and what the board should be or could be doing with the capital. What I'd say here is that for even the most conservative boards, and as we know, boards are a collection of individuals that all have different ideas about things. Usually there's low-hanging fruit. There's an opportunity to make cash work harder in a conservative portfolio at the very least. So what we're presenting is that boards should really be considering an additional untied source of revenues to contribute to their organisation effectively, not only in year one, but on an ongoing basis. So let's put some numbers around. This. Here we're starting with an example client, and I recognise that not all associations are have assets on their balance sheet at the same level. Some here will be earlier on in the journey, and I'm very happy to sort of tailor my discussions to, I guess, newer or less mature organisations. But we are talking about an association here that, through discussions, has determined that they have $1 million of free capital, if you like. Now, an ultra-conservative board would invest that $1 million in a conservative portfolio of bonds, and we are taking what I would consider to be a conservative return expectation for a conservative portfolio of bonds. These are basic income producing investments, and in year one, we can see that there is a $15,000 difference in the outcome between a portfolio that owns term deposits only and a bond portfolio that produces 6%. The same board may elect, if only for part of their corpus, but to invest in a more balanced portfolio, which we show as a net return of 8% per annum. So in year one, we've got an incremental total benefit of $35,000, and by year five, what we can see there is that there's an additional $204,000 that can go towards other projects and any objectives that the organisation may have. And this slide here is to highlight that investing is about taking advantage of compounding. We've all come across compounding, but it becomes much more meaningful over longer timeframes. So it's worth considering the various long-term outcomes using the same example, and we adjust that outcome for inflation. So we can see here that a passive cash portfolio, I guess an organisation that's leaving their corpus pretty dormant and just accepting what the bank is offering, might be able to, should be able to sort of double the value of their portfolio over 20 years. But they're in no better position, and they've really only just held that cash up in line with inflation. Because of the power of compounding, the cost or the pain in being apathetic or inactive is most acute in the latter years, where we can see here that after 20 years, even an investor that is investing in a conservative portfolio of bonds ends up with an outcome that's, after year 20, that's 50% better than that investor that only that left their cash pretty passive and passive in a cash management account. Now, of course, growth ends up being more than 2.5 times better off a growth portfolio here with an inflation linked return of CPI plus 4.5%. And that's for obvious reasons. And of course, growth isn't right for everyone. But what we want to really do is get to the bottom early on in the discussions in terms of what is a desirable outcome and what can be accepted in terms of volatility along the way. And this is the reason that we tend to advise and see groups tie their return objectives to CPI. The key message on this slide here is really to start early. Almost forget about what you've done in the last 5 years or 10 years, but start as soon as you can in thinking constructively about your investment strategy. Now, here's what share market investors have had to stomach over the past 15 years. And we can all sort of think back to March 2020, when we were starting to learn about the effects of COVID. We saw, as you can see on the slide here, we had the fastest bear market ever in history, and the economy was effectively closed. Volatility is the cost of investing in shares. The benefit is that you get the best returns longer term, and I strongly believe that if you can stomach the volatility, you're going to have the best outcome for the next 20 years. There's always a litany of reasons to worry, and I think as a board director, you're a custodian of other people's capital, and so you probably will tend to worry about this most acutely, which is why it's important to be to have that investment policy well designed, to understand what you invest in, and importantly, don't get caught up in the noise. Because this chart here, as you can see, the red line is the average annual return and tends to gyrate very widely. The long-term investor that's focused on the long term is the blue line, and you can see that the long-term outcome or average is a much smoother journey. So the noise from the prior slide tends to disappear over time. So in addition to starting early, try to dismiss the noise and stay focused on long-term outcomes. So we're just going to talk through, as I said, the investment policy statement, which is a term that is used across the not-for-profit space to outline some of the important considerations and constraints. Now, while I'm sure there are some associations out there across Australia that are set up to provide benefits temporarily, what my understanding is that associations are generally set up to provide benefits to members in perpetuity. So an investment policy statement is an all-encompassing constitution which provides guardrails and protections for directors now and in the future, and investment advisors alike. What I have seen is that an investment policy statement can sometimes effectively be written in an email or on one A4 page. I've seen investment policy statements that are 50 pages long. So there's no length or amount of content that's right for everyone. It just depends on the organization. But some of the important components that should stick out and should be included here, first of all, the roles and responsibilities. So who does what? Will the board delegate authority for the investment portfolio to the treasurer? Will there be a sub-investment committee? Will an investment manager be employed? What is their responsibility? And how are those people going to be held accountable? Liquidity is the second important component that should be there. So first of all, what level of cash should be retained in a liquid pool? What is left over that can be allocated to a longer term growth pool? And this is normally part of the process where in drafting these documents, we do seek advice from Francis and those that have the background and understanding about these aspects. But essentially, sometimes what we can do is look at operating expenses and write into the policy statement a minimum number of months worth of operating expenses that should be kept liquid in cash, and perhaps you bring in 1 year's worth of conference profits or conference expenses, because you just never know. COVID was an interesting case study for thinking about what can occur when membership fees change and change drastically, and a conference can't be held. For both the liquid pool and the growth pool, we want to talk about and look at how should liquidity be defined, what percentage needs to be available within 1 month, 6 months, 12 months, etc. Then we talk about and include what are the risk and return objectives, how much volatility or downside in any particular year or a 3-year rolling period could a board accept. Secondly, what level of income is required from that growth pool each year. So it's those important risk and return questions that we can include and document and ensure that everyone aligns to. Then you have, of course, reporting requirements. How often will we report? What's included in them? What are benchmarks? How will the investment manager be assessed and kept accountable? And then finally, we have ethical investment preferences, which tend to come up when you start to see larger amounts of funds and more established associations and organizations that really start to think about what their members want from a sustainable investment perspective. And this is, and we get into a lot of detail about this with clients just to ensure that particularly the investment portfolio is aligned to the organizational values. Ultimately, all of this information just dictates how the portfolio can be constructed and what mix of asset classes are most appropriate to achieve the outcome. So once the risk and return objectives are in place and risk has been assessed, the portfolio construction process begins. And the starting point with portfolio construction is to think about strategic long-term asset allocation. What is the targeted level percentage of the funds that can be invested in the various asset classes? So we do that because, as the chart here demonstrates, that asset allocation is the main driver of returns longer term. And what we're saying there is that if we maintain a certain mix of assets, this is the level of volatility we should experience, and this is the long-term level of return or annualized return we can expect to achieve. So the academic research is quite compelling there that asset allocation is most important when we're managing risk. However, there's still a meaningful 10% in that chart that shows that return can be also contributed to or explained by owning the best assets and knowing when valuations are expensive or cheap, and therefore, what percentage to have exposed to a particular asset class in any one point in time. And we refer to this exercise as tactical asset allocation. So strategic is your long-term targeted, and tactical is how you think you might like to be positioned over the next, call it 12 to 18 months. And we use ranges here. So most associations that are implemented an investment portfolio provide some flexibility in their investment policy statement for the portfolio manager to exercise discretion or advice within a particular range. Now, what you'll see is we never really go to zero in shares. And the reason for that is that even the best portfolio managers in the world understand that they can be wrong about the tactical positioning. They can get things wrong. Trump can be elected and markets are, going to continue to perform strongly for another 3 to 6 months, which was different to what our idea was 6 months before the election, for example. What we pay close attention to is market valuations. And I won't go into detail now, but I'm sure people have come across price earnings ratio as a typical metric that investors use to calculate whether a particular company or sector or market is expensive or cheap or reasonable. And it's really important to have a view on valuation, because the valuation that you're paying for now by putting $1 into the market is an incredibly important determinant to the return that you will receive on average over the next 5 years, for instance. So it's an important indicator, and this is what drives advice and feeds into that risk management process. So an investment policy tends to include both those strategic long-term weightings and the more shorter to medium-term tactical asset allocation ranges. So I'm just going to spend a minute now. You can see that we're coming up to 11:25. So I'll spend the next 5 or 10 minutes just talking through some of the opportunities associations tend to consider, and investors in general. And a lot of the principles today that we're talking through apply to a range of almost all investor types. So before I talk through a live example of a fixed income asset, as the name suggests, income is, and a fixed amount of income usually, or a floating amount of income is what this asset class is all about. The second benefit or attribute of fixed income is that it tends to be more liquid. So fixed income tends to play an important role within that liquid pool, or the defensive component of a growth pool. And we can design fixed interest portfolios and do for our clients with specific liquidity needs in mind. So to give you an example, so an association I was just talking to late last week wants to be able to fund a placement in 3 years' time. So they've got a horizon of 3 years. And what we're doing is structuring a fixed income portfolio to match that liquidity requirement and be able to forecast cash flows over the next 3 years to give some certainty and also optimize returns. And there's a lot of detail here. No fixed income investment is the same as the next. It's important to talk to someone that's experienced in bonds. But essentially, as this slide highlights here, a fixed income investment is one, it works very similarly to a term deposit, but they just tend to be longer term. So to talk through this example of the Macquarie bond, that is a live issuance issued by Macquarie Group. This one here is a floating rate bond. At the time of issuance, Macquarie Group also issued an equivalent, similarly structured but fixed rate bond. So what Macquarie said, I think it was 2022 when they issued this bond, was that, okay, investor, if you give us $50,000 or $100,000 to invest in this bond, we will give you an interest rate every 6 months. So we'll pay you a semi-annual distribution, which will equate to, just using simple numbers, 6% income return per annum. So you'll get 3% every 6 months. And then in 2027, on the call or maturity date, we will give you back your $100,000, and then you can go and reinvest in another one of our bonds or someone else's bond. So I guess just to validate that earlier slide around a fixed income portfolio, this particular bond is offering investors, for those that invest today, and assuming interest rates don't change, but even the fixed rate bond is similar, is offering a touch over 6% per annum until maturity date in 2027. What I am highlighting here on the right-hand side is that what we try and do is, in the defensive component of portfolios, is stick to high-quality issuers like the big banks and Macquarie, well-known issuers, usually Australian issuers, and we will invest in senior or subordinated debt. So as you can see, the higher up you go, the lower risk but lower return. We can access all parts of this capital structure of Macquarie on any given day for our clients, but for our defensive components of portfolios, we want to be sticking to senior and subordinated debt. The next asset class, just to mention, is the one that's very common and well known, I'm sure, by everyone in the audience, and I'm sure you're investing in the Australian share market through your superannuation funds. But why we like Australian shares and why it's an attractive asset class for associations is because with the Australian market, you get invested in a high percentage of that market is mature companies, where those companies have decided that there's not a high percentage of their net profit that they generate that will be recontributed back into growth of the business, but rather they're mature and they will distribute out a high proportion of their profits or income in the form of dividends. Now, I could spend an hour talking about the current valuations of Australian banks and why that is an interesting asset class or part of the market at the moment. For only the second time in history, the major banks actually have a dividend yield because of the share price increase, which is lower than the term deposits that those banks offer. But one of the other benefits of Australian shares and banks is that we all know those companies. We all bank with at least one of the banks. We know the brands, and arguably, for most, we trust the risk profile of those companies because of the prudential regulation and monitoring of those companies, more so than, say, an American or a Chinese bank. The franking credit system is unique to Australia, and what I work with new clients, with new association clients, is just ensuring that an association is registered to claim excess franking credits. And most here will be part of an organisation that is a not-for-profit, meaning that they're not paying tax on the capital gains or the income. But attached to the income is basically a certificate that they can lodge with the tax office at the end of the year, and claim those franking credits back as a cash refund, which adds to the return from Australian shares. And usually, organisations and investors get a check back after they lodge their documents, and that franking credit amount is paid to their cash management account. So all in all, Australian shares provide a really important role in portfolios, but it is just worth understanding how concentrated the Australian market is. And I mentioned the banks, but when you add the banks and the mining companies in the Australian market, which you can see on the bottom right hand side here in the light orange bars, a very high proportion of the market is in those two sectors. So you get a concentrated market and concentrated to sectors that tend to be cyclical and far more cyclical than some of the other sectors that you tend to have more exposure to in other indices throughout the world, such as the S&P 500, which is the comparison here. So you tend to get more diversification from offshore investment, and that's why we consider international shares as well as part of the mix. Of course, the slide is sort of showing that the Australian market is a very tiny market. So the other benefit of international markets is that we can access 80,000 companies that are listed. That not all of those meet the criteria and are suitable, but there's a much bigger universe of opportunity. I think the important point, or a couple of important points here just to finish off, is that with the S&P 500, you are gaining more exposure to companies that aren't distributing as much of their profits as dividends or through share buybacks, but are instead reinvesting in themselves for future growth. So even considering the current valuations of some of the mega caps in the market, like Amazon and Alphabet and Microsoft and Nvidia, even considering those valuations, when we add all of the components of the total return that we're going to expect over the next 5 years and look at the consensus forecast for earnings growth, both markets, we end up concluding that there's a higher return outcome over 5 years from the S&P 500 and from those companies in the US. The final point here on this slide is just to say that we recognize the importance of avoiding missteps in portfolios. And I think avoiding missteps is a really important message just to send to directors and those that are custodians and stewards of other people's capital. We look at those 80,000 companies. When we filter for some attributes that we define as high quality, and I'm talking there about higher return on investment than the broader market, very safe balance sheets, in most cases net cash, so actually don't have any debt, good management teams, all of those things that are important for long-term sustainable outcomes. What we end up getting to out of that 80,000 list is a list of 65 companies at any one time that meet all of those criteria. And what we finally end with is a portfolio of the 15 best valued opportunities within that list of 65 that we manage in portfolios. So just to point out that when we're thinking about share investing, I'm sure there are some people in the audience today that get a little bit nervous about share investing. We take a more conservative approach to share investing, and we're looking for companies that are large companies that are diversified, that are well managed, have safe balance sheets, and will stand the test of time and be able to weather any storm. So the final asset class just to talk through here is the alternatives asset class. Now, alternatives are defined not by what they are, but what they are not. So they're not the asset classes that we've just talked about, like public bonds or credit and public equity or shares. They're basically everything else that's not traditional. And what you're seeing across the investment landscape, even if you look at the likes of the Future Fund and offshore pension or big endowment funds, is a move into having a much higher percentage of their total investment corpus invested in private assets. So there's just so many more companies that are private, and they're still large companies and high quality companies that you can access in private markets, either by lending money to them, and we've referred to that as private credit, or investing in their equity. But within alternatives, you also have other asset classes like unlisted property, commodities, and hedge funds, a range of other investments or asset classes where each of those asset classes have their own risk spectrum. So you can get conservative hedge funds and conservative commodity funds, or riskier hedge funds. But the idea is that by including alternatives into your portfolio, you get a smoother return profile, less volatility, uncorrelated sources of return, and ultimately a better return outcome. Otherwise, the likes of the Future Fund wouldn't be doing it. The one caveat to that is that they tend to come with less liquidity than public markets. And so therefore, it's really important to think about what percentage, if any, of your investment corpus can be invested in alternatives that aren't necessarily going to be able to be liquidated in the next 3 months or 3 years. So I guess it's a very broad asset class, but it's really an important and an increasingly important asset class for driving returns. Just a final slide before we hand over to questions. I just wanted to provide some of the longer term returns that we've achieved for the not-for-profit clients that we advise. To highlight a few things on the slide, first of all, the 8% annualized return that I extrapolated out for 20 years in one of those first slides, you can see here has been achieved and is achievable for a balanced portfolio. The second part of this slide is just to highlight that no one client is the same as another, and these are real clients. So 1 to 4 here are very different clients with different risk and return objectives, and we have a different mandate with each. And finally, just to highlight that we do have a strong record in achieving good long-term outcomes for the not-for-profit clients that we advise. So with that, I will hand over to Francis just to maybe take some questions or possibly, first of all, wrap up the presentation.
Yeah, thank you, Ryan. That was fantastic, an incredible amount of information there, and I hope everyone's able to take it all in. And if not, as I said, the slides are available after this. But I suppose some of the messaging from that for me is, it has to be a collective board approach to this. You need to make sure that your board understand the implications and risks of what they're doing. You need to have, properly understood what funds you have available and where they're going to be needed over the next few months or few years, what benefits you're hoping to fund. You need to have a documented policy at board level. Make sure that the decisions you make are properly recorded. Ultimately, you don't want to be at risk of being accused of making incorrect decisions. So make sure there's a proper policy. Invest in making sure your board understand what they're doing. Association specialists, just my one sales pitch, do have some webinar series on this. Certainly provide some access to that. And ultimately, the most important thing is to make sure you're getting advice from somebody who's qualified. And certainly Ryan and Evans and Partners are highly qualified in this area. There are risks, obviously, from time to time with financial advice. And I suppose, Ryan, if there's one quick question I have from the floor is, if you did have some advice about making sure your financial advice is coming from places, and anything people should look out for, there's the old thing of if it turns too good to be true, it usually is.
Yeah.
I'm just wondering if there's anything specific they should be wary of.
Yeah, look, I go through lengthy due diligence processes with prospective clients, and first of all, there's a lot of information on the internet, and I think people tend to read reviews. I personally think the best due diligence you can do is to talk to some existing clients, or if you're talking to an investment advisor, request a couple of references and particularly phone numbers, so you can give those clients a call and just validate some of the information and do your own your own homework. I think that's the main one that I would suggest.
No, great, thank you. Emma, I don't know whether we have any other sort of questions in the chat or whether anyone's put their hand up and wanted to ask anything.
Yes, if anybody does have any questions, then please do pop them in the chat.
You still feel, please?
Is this MJ Bale?
Oh, no, it's Anthony Squires.
Don't worry, the representative.
Oh, guys, if you're not asking a question, then try and stay on mute. But if you would like to come off mute and ask a question, then do feel free. If you do pop them in the chat, then we can manage them that way. Just to sort of break the ice and get the questions going, hopefully. I had a question for you both, which is, If I was sort of working with a smaller association, is there any sort of cut-off point, or how much are we talking as far as sort of a minimum investment goes, to sort of help people on the call sort of assess whether or not they qualify for this strategy or not?
Yeah, I'll
you go,
take
Ryan.
that one. Yeah, okay. So first of all, I'm very happy to talk to any association, regardless of what their starting point is. And I think that there's some interesting investment options that are available in the market that are diversified. The evolution of an introduction of exchange traded funds are available on the ASX. You can buy a diversified senior bond fund, or a diversified subordinated bond fund, or a multi-asset class investment yourself. So you don't necessarily need you don't need an investment advisor to do that for you. I think the other point is that we're trying to just reinforce that being proactive with the corpus is important. So there are cash platforms available, and one of them, just to mention one, is Australian Money Market, that give you access to a range of different deposit-taking institutions and allow you to match off and almost negotiate better rates for your organisation. So Australian Money Market, I think, has 13 these days, 13 banks, and they tabulate and report to you on any given day what the rates are that are available across those banks. So you do all of your paperwork and set the account up directly with AMM, and they liaise with the various banks on your behalf. There's always something you can do. There's always something that you can do to take a step in the direction of being more proactive with your investment portfolio, but that might be a more passive approach early on. So yeah, very happy to point people in the right direction.
And thanks, Ryan. I have another question actually, which might be directed to both of you. But so if somebody's on the call at the moment and they've listened to your presentation, Ryan, and they think, actually, we do have an investment plan, but it's not performing the way that you've suggested it could be. What is the best way of sort of then taking this information back to a board and, say, encouraging for whatever investment strategy is currently active to be reviewed?
Yeah, and I think that there are a number of different things that can go awry or not perform in line with expectations, and sometimes that's around service level from an investment advisor. Sometimes that's just returns and performance. And so the investment policy statement or plan usually has a return objective in it. And so I think if you're not achieving that objective, in the very short term, you have recourse to talk to your existing investment advisor and find out why. And then I think if it becomes sustained or you want a second opinion, that's when you might engage another investment advisor. And usually early on in discussions, information is shared, and another second opinion can provide some comments around why you might not be achieving the outcome that you're expecting. So yeah, I guess it's less about who is responsible for addressing it, and more that it's a responsibility of every board to ensure that they are achieving the returns that they set out to. Because if they're not, technically that's a breach of policy, or something needs to be adjusted.
Thank you, Ryan. We have got somebody with their hand up at the moment. So I'm just going to ask you to unmute, and then you can share your. Off you go.
Thank you very much. My name is Can Yashmut. I'm the CEO of the Local Community Services Association. We represent about 175 neighborhood and community centers across New South Wales. We have learned from our colleagues and counterparts in the UK that during the austerity measures there in the not-for-profit sector, there was a large proportion of organizations that didn't survive. And those that did survive were the ones that owned their own assets, mainly their own buildings. So this is not long ago. So we're talking 4 or 5 years ago, and not that I'm predicting necessarily that we find ourselves in an economic situation like that, Ryan. But my question to you is that I'm really a strong advocate that our members, where possible, purchase the building that they operate out from as a economic investment and also as a fallback option if funding dries up or things happen. So, and LCSA is my organization is in the same situation. Our equity is not very large. We've got $300,000 sitting there, but how can you enter a property market where usually those bigger buildings we're looking at several $1 million? Is there any particular way, incentives or advice that you can give how small and medium-sized organizations with a modest retained earning fund can enter the market, the property market?
Yeah, and thanks for your question, Johnny. The first point I would make is of paramount importance, and you mentioned it, is ensuring that you have beneficial ownership of any assets that you invest in, regardless of what that asset is. So that might be direct ownership of a property, direct ownership of shares, or using a recognized large safe custodian, which is common across all organizations now, including the big superannuation funds employ independent custodians that have to keep assets separate to their own balance sheet. The heart of your question was around how can an organization access commercial property or the property market if they've got a smaller amount of equity. I think you'd have to understand what your borrowing capacity would be in the first instance and whether your constitution allows borrowing. But what I'd say is that it's not necessarily the best approach to own your own asset. Sometimes to own the asset that you that you employ yourself and operate out of, and ultimately, what the decision process should be there is that particular asset strategy going to deliver the best returns on the capital being employed. So I've actually just had a large charity client of mine sell a commercial property that they've been in for, I think, 15 years. And they sold that asset for 9 million because what they determined was that they are going to get better returns and have more liquidity and be able to employ their capital better through a balanced investment portfolio. So it ultimately comes down to the actual asset, but in terms of how you finance that will be dependent on the actual organization and their access to debt financing or equity if they've got it. Does that answer the question, Johnny?
Yeah, it does. I'm just wondering, I mean, given that I don't think I fully understood what you said at the beginning with the larger superannuation funds. Were you suggesting that they can act as a guardian?
No, sorry. I was just suggesting there that the investment portfolios that we run, for instance, beneficial ownership is retained at all times by those organizations. So they, the assets are theirs, but what they also do is employ a custodian to hold those and house those assets for them. And the custodian's role is just to hold the assets legally, and so that you can transact and make changes to those assets more effectively. And those custodians are very heavily regulated and need to be audited or audited daily, audited independently as well. So the point there is that I was more coming back to some of the not-for-profits that got into trouble in the UK, where it was the risk management of how they held their assets, as well as obviously operational reasons, as to why they had a systemic issue there.
Thanks, Ryan.
Great, thank you very much, Ryan. So a strong start to a Tuesday talking about investment strategies. And I think that's going to call the session to a close. We haven't had any other questions. So as Francis mentioned, if you would like to consider the TAS Academy for further sort of investment learning, then do scan the QR code.
I think my one thing is that, you know, you do have a duty to act in the best interests of your members. This is something that needs to be considered, needs to be worked through, it needs to be risk managed.